You're listening to the Moneyweb Now podcast series with Simon Brown. Live streamed every weekday at 6:30 a.m.
It's Monday, 24 August. Today in 1949, NATO went into effect. I'm Simon Brown, coming at you live and loud from Moneyweb Studios in Gauteng, Johannesburg. On the show today, Jimmy Moyaha. I want to touch on those Cell C results. I don't know, I thought they looked really, really good. Well, stock slightly below that November IPO price. We're chatting with Tasneem Samidian from Old Mutual Private Clients. Richemont, tough decisions that took a decade ago paying off. The Renafissa ETFSA, as they launched their Navigator tool. This podcast is brought to you by Stanlib Asset Management. Invest in more global opportunities through their partnership with JP Morgan Asset Management. Morning headlines, Moneyweb. The Fashini Group commences Section 189 processes. Head office role could be affected, but questions linger about manufacturing. And Business Day, Eskom slashes spending on diesel by over 80%. This is open cycle gas turbine usage drops to just over 1%. Morning markets, US was green, S&P 0.4 higher and Nasdaq on Friday 0.3 higher. East mostly red. We've got Sydney a third up. We've got Tokyo down just over 0.5%, Hong Kong down just over 2% and Tencent 3.7% weaker. Commodities almost all green. Gold futures 4,703. Brent is the red 93.16. Platinum 1,898. Palladium 1,375. The Rand is 16 exactly. Bitcoin is 77,100. And top 40 opening call looking for a red open, 450 points, 0.4% lower.
Moneyweb Now, on the money. Also available on podcast.
Chatting now with Jimmy Moyaha. Jimmy, those Cell C results on Monday. I said there that the IPO price was 26.50, stock trading at 26, so a little underwater. But when I dig into it, I mean, the share price 26 rand. They put HEPS at 23.38. I had to triple check that number. I mean, it seems like the stock is offering value. The market perhaps just not convinced just yet.
Yeah, morning, Simon. Remember, this is the first official set of numbers since the IPO itself, a full set of numbers for the full year, that is. Now, if we look at the numbers, all the numbers do check out, as you rightly mentioned. Revenues up 13%, net debt down to the 2 billion rand mark from almost 6 billion rand. There's huge cash available from a business perspective. All of the numbers point to a very, very strong business if we're looking at the balance sheet. But remember, this is a business that's just undergone a restructuring. It's a business that has fundamentally said to the market, we are going for a different value proposition to what the other telcos might be doing. And at the moment, most importantly, as Wayne McCurry often reminds us, markets have memories. And the memory that we have of this particular stock is one of a business that was heavily invested in by Blue Label, to the point that those investments weren't working out and Blue Label had to write down this particular asset to zero. Now, this was, of course, prior to the IPO. So for the market, there is a long history here to be aware of and to be cognizant of where it relates to this business. To their credit, Cell C, though, they've fundamentally changed how the business operates. They're asset light. Yeah. They're focused on a balance sheet. They acknowledge that they use, and they openly acknowledge that they use the infrastructure of competitors like Vodacom and MTN. They're fundamentally building themselves as a very different business with that huge focus on mobile virtual network operating services, as opposed to what we're seeing perhaps some of the other telcos focus on. Their model is to come in to look at the wholesale market as well. If you're looking at some of the performance as well, the voice traffic that they've been generating, that's down, whereas data traffic is up. Their prepaid is making more money than their postpaid. It looks very, very different in terms of the nuts and bolts of this business when compared to the other telcos in the market. And perhaps that's what Cell C is trying to tell the market, is we've got a new operating model. We've got a new business model following out that restructure. And the market is perhaps saying, well, it looks pretty, but does it work?
And that is it. They are really coming. We've got MTN and Vodacom. Of course, they've got operations into the rest of the continent. We've got Telkom, who's got some fiber to the home and business stuff as well. They really are saying we're different. We're that MVNO and a fundamentally different proposition from an investor perspective.
Absolutely. And from an investor perspective, I mean, if you look at what is out there in the market, you'd have to then take a look and decide whether or not this business model is one that you're looking for in a telco. We know how Telcom recently sold off their SwiftNet business. Well, not recently, a couple of financial periods ago, but they made that fundamental decision because they decided to focus their model on the fiber side of things. The likes of Vodacom and MTN have been expanding into Africa, into the Middle East. Some have been getting out of the Middle East in light of the tensions there as well. That's had an impact on MTN's numbers, for example. But for Cell C, in a market where you and I have spoken about this in the past, the market doesn't have enough space to have 6 or 7 telco providers. Perhaps this is their differentiator. You come to the market and you say to the market, we will do this differently to what other service providers are doing. As it is, they act as a service provider for the likes of the Capitechs that offer their MVNO services. So perhaps they're looking to be the service provider to the service providers as opposed to chasing their own revenues and chasing their own client base. They did report an increase in subscribers, of course, but it might be easier to hunt down one subscriber that has multiple subscribers as opposed to going after them yourself. The question, though, is will it work for Cell C? We know the likes of the Pepcore Group have decided they're going into this offering from their perspective, and they have the reach and the footprint from a store perspective to be able to do this alongside their own customer base. A lot of these competitor companies that might be looking to offer MVNO services, the banks, all of those that are currently not serviced by Cell C might have existing client bases that they don't necessarily want to give up. So if Cell C can provide a value proposition, perhaps that's how they win the business. I guess the market at 26 Rand versus 26.50 is saying, well, maybe we did get the fair value right.
Yeah, actually, that's a good point. That's a good point. And I do. It's an interesting business model. We'll leave it there. Jimmy Muyaha, appreciate the early morning time. That's our poll today on LinkedIn. Do you think there's value here in what is SA's smallest telco, but an interesting and different business model? Have your vote. Have your say. LinkedIn. The Standard Flexible Income Fund delivers capital preservation and consistent top quartile inflation-beating returns. Let your money keep working with Stanlib Asset Management even after you retire.
Moneyweb now on the money.
Chatting with Tasneem Samirdin, she is research analyst at Private Clients by Old Mutual. Tasneem, appreciate the time today. Thinking about Richemont and going back a decade, and I remember this at the point, there was a fair bit of luxury pressure in the luxury goods market, fair bit of turn down in the market. Richemont at the time responded quite decisively. They bought inventory back from the sort of wholesalers and fundamentally changed their business model, going from wholesale to more direct to consumer. It wasn't an easy change, but it's really benefited them.
Thank you for having me. Yes, Simon, I'm giving away my age now, but I remember it like yesterday, ahead of the AGM around 2017, 2018, Richemont put out a notice to say its operating profit was going to be down about 50%. And obviously there was a sell-off in the market and we were investors at the time. So it was a very painful period for them. And they could have waited, for the luxury market to turn because there was an overall slowdown. But I think management acted very decisively in saying, look, we know that there is a downturn, but we also see these gaps and the issues in our business. And we are actually going to take action. We're going to buy back watches from the grey market. We're going to take more control over distribution in order to take more control over pricing. And it cost them for 2 years, there was, this share price overhang as management was instituting these actions. And so it's so pleasing to see, 10 years later, that those changes that they made to the business is now placing them in such a strong position to outperform their peers and outperform the overall sector.
I'd forgotten about that collapse in the profits. I'd remembered the sort of luxury downturn. I'd forgotten just how bad it got. I was also at that point in time a shareholder, and it was nasty on the share price. But it has worked. I mean, direct to consumer is now over 3/4 of group sales. A decade or so ago, it was around half. It was a big move. It's absolutely paid off, just in terms of the numbers.
Yeah, I think we must also remember at the time, it's easy to say now that everyone's going direct to consumer. But back in the day, it was very traditional for luxury brands to focus on, brand equity, building the brand, and for wholesalers to distribute the luxury products. So that was very much the status quo. It was kind of going against the grain to say, we are going, as a luxury brand, we are actually going to go into retail. We're going to own our stores, put our own retail staff, build relationships with customers. That was going against the grain, building our own e-commerce platform. They kind of did what other peers weren't willing to do, and the peer group obviously certainly followed after that. But now they have much stronger relationships with their clients that is actually filtered into how they design their products. And if you go on the online site now, you can actually influence the design of your Cartier Love bracelet, for example. So it's placed them in a much stronger retail position. Apart from, just taking control over distribution, there's been multiple ways that it's actually made them much stronger and improved their brand equity as a result. But now the business is, much more. Back in the day, it was 50-50 wholesale versus, direct to retail. And now it's predominantly direct to client.
And I get your point. It does. It gives them more control over that relationship. Aside from, pricing and inventories and all of that, it is that direct one-on-one relationship, which can go wrong. But in Richemont's case, it's really, really worked. We've also seen jewelry become more important than watches. I mean, way back in the day, I remember with the first smartwatches and concerns around Richemont, because they were so reliant on watches, they have also leaned a lot more heavily into jewelry instead of the watch.
Yes, that's true. Like 10 years ago, Richemont was, the struggling luxury watch company. That was very much the narrative. But it's leaned, and obviously management paid attention to this commentary and the concerns of the investor base. So they've really leaned heavily into Cartier, into Van Cleef. They've bought more luxury brands along the way, driving that brand equity and also just better able to build a story, build a relationship with the customers around, when you buy your Love bracelet, the Alhambra design that is very popular with a younger luxury consumer. So they have leaned into it, and it is a category are much more able to influence pricing, whereas specialist watches or luxury watches, then there's a lot of nuance that goes into how watches are priced versus how the jewelry category is priced. So I think it was absolutely the right action to increase the contribution from jewelry in their business and decrease the exposure to the overall luxury watch category.
And if we look across the sector, and there isn't sort of really one-for-one comparison, there are other luxuries, but LVMH has got everything from, fancy whiskies onwards. Richemont really stands on its own as sort of proper, pure luxury, and it's also made it a much more defensive luxury good company. Companies often pivot and make changes. This is almost an MBA study in it going incredibly well and benefiting shareholders and the company itself.
We must say that while there was clear management action, to tilt the portfolio in the direction of jewelry and take back the relationship with the customer, there's also a bit of luck in that the jewelry category in particular is benefiting from this precious metal price tailwind. Richemont has not increased its prices significantly to compensate for what we've seen happen in the gold price and precious metals. So customers have this perception that they're not just buying a piece of jewelry, they are also buying an investment. The item that they purchased a year ago is worth more today just based on the gold content, on the precious metal content. And that is also supportive of demand. And we've seen that play into Richemont's rating.
I hadn't actually thought of that. Of course, just the good old-fashioned metal prices or precious metal prices helping significantly. Leave it there. Senior Somodine, research analyst, private clients by Old Mutual. Appreciate the time. Think you found the perfect investment? Let's check. Join Moneyweb editor Ryk van Niekerk, the Money Summit, where he will reveal the warning signs of today's biggest investment scams. From fake trading platforms to promises of guaranteed returns, learn how to protect your money before it's too late. Tuesday, 1 September at the Sandton Convention Center. Register for free using the promo code MONEYWEB. Visit moneyweb.co.za and secure your seat today. Give your money the return at once without taking a flight with the Stanlib Global Select Fund, an offshore equity fund submanaged by JP Morgan Asset Management.
Moneyweb now on the money.
Chatting now with Nerina Fisser, she, of course, a director and strategist at ETF SA. Nerina, appreciate the early morning time. Friday, you were demoing the new ETF SA. You're calling it the Navigator. I suggested it's kind of a bit of a robo-advisor. You shut me down a bit on that and said it kind of sits in the middle, I suppose. It's an assistant to help me put together and design a ETF portfolio on my requirements and needs.
Absolutely. Morning, Simon. Yes, we see it more as a co-pilot, maybe rather than a robo-advisor. I know that robo-advisor comes with a lot of preconceived ideas in terms of what happens in the back end. And I do think that the ETFSA Navigator operates on in a different way. Most importantly, I think many traditional robo-advisors use mathematical and statistical tools, algorithms at the back end to optimize a combination of portfolios or ETFs or investment products that is sort of optimized to give you what the tool would think would be the best returns given some sort of historical return profiles. But our view is much more that we are looking here to help clients match their investment objectives, the requirements that they have from their investments to a particular combination of ETFs. So ours is much more almost a deterministic tool that would take your requirements, convert them into, from sort of wordy wants and needs to how do I actually get that from the combination of ETFs that we then recommend for the clients.
And that's just it. So it asks me a couple of questions. And, they're around timelines. Am I looking at short or longer or medium sort of term? It asks around sort of offshore, onshore. It asks around, can I really do a side with the money? It also checks that I have an emergency fund. And then in essence, it's giving me a nice portfolio that fits a couple of simple questions. I like what you say there. This is just making it a simpler, less stressful process for me, because there's no rocket science here, but we can get tripped up on some of the processes. This just makes it nice and easy.
Indeed. I think what we often find is that clients battle to translate their understanding of what it is that they're looking for from their investment into the choices of investment products, which they are expected to assess on some sort of jargony objective or time horizon, which is inconsistent between different providers, or risk profiles, which are inconsistent between different providers. So we've taken all of that sort of guesswork out of the equation for the client and say, let's help you bridge that gap between what you want and need to where we think you can get the best combination of what is required. I think really important here is also to help clients understand, what does it mean when I say I am, for example, my time horizon is at least 5 years. I want a long-term investment. But then you turn around and say, oh, but I've got very low risk, and please make sure that this portfolio has got a lot of income. Oh, and by the way, I want everything offshore as well. Now, many of those things are quite inconsistent. And so we would also come with some feedback and say, based on the combination that you've sort of specified, there's some inconsistency in here. Are you comfortable to proceed with what you've put here, or can we maybe help you redefine sort of some of these categories to better reflect not just what you need, but the reality of how investments work? I mean, we know that offshore investments, for example, is not where we go for yield. We're not going to get high interest rates or high dividends from offshore investments. So those two things are almost incompatible or inconsistent. Similarly, also, it's very difficult to think of a low-risk portfolio and 100% offshore. Even if you've got an offshore portfolio with a relatively low risk, the currency component necessarily makes that more volatile, more risk from that perspective. So for us, it's really about having this engagement with a client to help them translate that. And I think very, very important at the back end of all of this is a human advisor who at any point during the journey, the client can say, you know what, can I please just speak to an actual human being that can help me understand what I'm doing here or guide me as my co-pilot on this investment journey.
100%. We always, I think, I agree on that, that sometimes we just actually want to speak to a person. There's There's also the other point, I was doing an event recently, and I was doing this idea: could we, an ETF portfolio in 10 ETFs? And it struck me 10 was far too many, 8 was too many, 5 was probably the right number. I suspect it's not going to come back and give me a list of 20. It's probably going to give me, probably just a couple of ETFs that meet my needs, because that's the beauty of ETFs, simplicity.
Absolutely. So, of course, it does depend on what the makeup of the underlying ETF is. If you're dealing with a fairly narrow, concentrated, specific exposure in an ETF, it's certainly not suitable to be the only ETF in your portfolio. But if it's a well-balanced, diversified, multi-asset ETF, you might find that a single one is enough. So we do also use, one of the questions that we ask in the ETFSA Navigator is, what amount of money are you looking to invest? Not because we're trying to gauge, should we give you good service or not? Definitely not. But the amount of money that you have available invest does to some extent also determine how many ETFs can I, if I say, afford to have in my portfolio. This is about in how many slices can I divvy up this amount of money that I will be investing. And so that's the reason why we ask that question. If you've got a relatively smaller amount of money, you should expect to find only 1 or 2 or 3 ETFs in your portfolio. If you've got a more substantial lump sum to invest, then you can afford to get more granular and have a more comprehensive portfolio of ETFs. So that's part of the guidance that I think we give is to, again, help translate what exactly it is that I have available, what it is that I want to do, and how can we help you to best implement that in a well-diversified but very suitable portfolio of ETFs for your needs.
Yeah, and then sometimes it's going to come out with, for example, your Oyster ETF, which is then ETFs in the ETFs. But for me, it looks as just one. We'll leave it there. That's Narina Visser, Director Strategist, ETFSA. Always appreciate the early morning insights. That's it for today. We're chatting with Luigi Marinis on Friday, from PPS Investments, talking around the need for active fund management. Markets that are with high valuation, high concentration, high risks from geopolitics and the like. He makes a case that, maybe we need to sort of pick up more on active and maybe dial back a bit on the passive. We asked you preferring active over passive in this environment. Over half of you said a blend of both. Quarter said, yes, it's wild out there. The rest were saying, nope, always just passive. Have your vote, have your say, LinkedIn. This podcast is brought to you by Stanlib Asset Management. Invest in more certainty to navigate volatile market conditions. We're live every weekday morning, the Moneyweb website and the app, 6:30 a.m. podcast just after 7. Thanks to my team, Eddie Nobokle, Nicole Sabu, to you for listening, my guests for their time. My name is Simon Brown. This is Moneyweb Now. We'll chat again tomorrow. Total results.
You've been listening to another Moneyweb Now podcast, posted every weekday at 7 a.m. on moneyweb.co.za. Moneyweb Now, on the money.